A trader in Seoul opens her brokerage app and watches her entire position vanish in 6 hours. Not down 50%, not down 70, gone, zero. The culprit, a 3 times leveraged ETF tracking a single US tech stock that gapped down on an earnings miss. She wasn't alone. Thousands of South Korean retail investors watched the same thing happen across multiple products in the span of a single trading session, and the flood of complaints that followed triggered something unprecedented. In early 2026, South Korean regulators announced they're banning single stock leveraged ETFs entirely, not restricting them, not adding warnings, pulling them from the market. These are products that let you bet 2 times or 3 times on individual companies like Tesla or Nvidia with the click of a button, and they've exploded in popularity over the last few years, pulling in billions from retail traders chasing outsized gains. But South Korean regulators didn't just tap the brakes. They looked at the data, saw something that concerned them enough to take the most aggressive regulatory action we've seen in this product category and shut it down. So the question I wanted to answer is this. What did they see that made them move this decisively, and should US investors holding similar products be paying attention? Second, the daily reset problem gets dramatically worse with single names. I mentioned volatility decay earlier. That's the phenomenon where leveraged ETFs lose value over time, even if the underlying asset ends up flat. Because of how the daily rebalancing works, every day the fund resets its leverage ratio to match its target 2 times, 3 times, whatever it's designed to deliver. That reset is based on the fund's net asset value at the end of each trading day, and it means the fund is constantly buying high and selling low in volatile markets. With an index, that decay happens, but it's smoothed out across hundreds of stocks. Some go up, some go down. The overall volatility is dampened by diversification. With a single stock, especially a volatile one like a tech name, the decay accelerates. If the stock whipsaws up and down, even if it ends the month where it started, the leveraged ETF tracking it will have bled value. South Korea's regulators cited this as a core issue. Traders didn't understand they were holding a daily trading instrument, not a buy and hold investment. The product design was burning them, even when they weren't technically wrong about direction. Let me give you a concrete example of how this plays out. Say a stock opens at $100. Day one, it jumps 10% to 110. That's the language you use when you're worried about contagion, not just consumer protection. That's the language of systemic risk. So here's what I think that means. South Korea didn't ban these products because a few people lost money on bad trades. They banned them because they saw the potential for a cascading failure. A scenario where a sharp move in 1 or 2 stocks could force liquidations across leveraged products, amplifying the move, destabilizing the system, and potentially spreading to other parts of the market. That's not a retail protection issue. That's a this could break something bigger issue. Here's what I take away from South Korea's move, and what I think it means if you're a long-term investor focused on building wealth for retirement. If you own single stock leveraged ETFs, or you've been tempted to use them, South Korea's regulatory action should be a wake-up call to revisit why you're holding them and how long you plan to hold them. These are daily trading instruments. They are not buy and hold investments. The prospectus says this, the regulatory filings say this. The product designers will tell you this if you ask them directly. But the way they're marketed, the way they appear in your brokerage account right next to regular ETFs, the ease with which you can buy them, all of that creates a false sense of equivalence. It makes them feel like just another fund you can add to your portfolio and check back on in 6 months. That is not how they work. If you don't have a plan to exit within a day or two, maybe a week at the absolute outside, you're using the wrong tool for the job. The math will work against you over time, even if you're right about the stock's direction. I want to be clear about something here. I'm not saying these products should be banned in the US. I'm not even saying they shouldn't exist. There are sophisticated day traders who understand the daily reset, who understand volatility decay, who understand the risk of total loss. And for those traders, a single stock leveraged ETF can be a capital efficient way to express a short term view. You can get leveraged exposure without a margin account, without the risk of a margin call, with defined risk. If the position goes to zero, you lose what you put in, but you don't owe your broker money beyond that. For someone who knows what they're doing and uses these products as intended, they serve a purpose. The problem is when they get marketed or used as long-term holdings by people who don't understand what they're buying. When someone sees a 3 times Nvidia ETF, thinks it's a way to supercharge their conviction in Nvidia's long-term growth story, buys it in their IRA, and holds it for 6 months, that person is going to get hurt. Not because they were wrong about Nvidia. They could be completely right about Nvidia's business prospects and still lose money on the leveraged ETF because of how the daily rebalancing works. That's the disconnect South Korea saw playing out at scale, and that's what drove their decision. More broadly, this is a reminder that leverage, in any form, amplifies not just returns but risk. And when risk gets amplified across millions of participants all making similar bets, it creates fragility in the system. South Korea saw that fragility and decided it wasn't worth the systemic cost. Whether the US follows suit or not, the underlying risk doesn't change. The feedback loops don't disappear just because the market is bigger or more liquid. They're still there. They just haven't been tested at the same scale yet. For most of us building wealth over decades, the lesson here is the same one that's always been true. Complexity and leverage are not your friends. Diversification is. Time horizon is. Do you understand how they work? Do you know what happens if the underlying stock gaps down overnight? Do you have a plan for when you'll exit? Or are you just hoping the stock keeps going up? Those questions matter because the product won't give you the benefit of the doubt. The math is the math, and it doesn't care about your intentions. This is educational content based on publicly available information about South Korea's regulatory actions and the mechanics of leveraged ETFs. It is not personalized financial advice. If you're holding these products or considering them, consult a licensed financial advisor who can assess your specific situation and risk tolerance. Thanks for watching. I'll see you in the next one.